Q1 has come to a close. Q2 2025 is in full swing, and it is time for us to do yet again another market update. Why is that? Because the world we live in is dynamic, it is ever changing, and what we thought would happen just 3 or 4 months ago, well, there's new predictions, there's new movement, and it requires a conversation. Ladies and gentlemen, boys and girls, children 18 plus, you are tuned in to the Loan Officer Podcast with me, Dustin Owen, and my main man,
JC
John Coleman.
Yo, what's poppin'?
Just booked my flight to Mastermind Summit.
Vegas,
it's a real deal. Vegas. It's Vegas, not Vegas. I like to say Vegas. I don't know why.
Hold on, you did book your ticket?
I booked my ticket, yeah. You book yours yet?
No.
Yes, you got to book it. You, Steven, Mark, Doc, y'all got to book your tickets. And you got to get your hotels booked too.
Whoa.
My hotel's covered. That's what happens when you speak at the event.
What?
Yeah. But y'all got to book your hotels. Don't worry. I'm going to have you, Steven, and Mark all sharing in the same hotel room.
We will, because it'll be a suite on the 90th floor. You're damn right. Penthouse style. So I'm glad I'm glad I approved that myself.
Expense approved.
I thank you. Thank you for that.
Yeah.
That's a great idea. Instead of 3 crusty rooms that smell like cigarette smoke, let's take up a suite.
Yeah, no, I spent like 3 hours booking travel. Look, I had a book. You and I are going to Chicago. Mm-hmm. Right, we're gonna go hang out with our guy Dave Hochberg. Right,
never met him.
Yeah, well, I have.
Okay.
And anybody who lives in Chicago and you listen to
he's a big
WGN Radio.
This is that guy.
Yeah, it's a big deal. Yeah, you listen to WGN Radio on Saturday, you probably know Dave Hochberg. So we're gonna go up there and do some content with Dave.
Oh shit!
I had a book travel. You and I are gonna go back up to Greenwood, South Carolina, to hang out with our girl Nicole Munderland.
Greenwood or Greenville?
We're going to Greenwood this time.
Oh,
we're going to Greenwood this time. We have to fly into Greenville.
Okay,
but then we're gonna go down to Greenwood and spend some time with Nicole. We're gonna do some content with her. She has a builder down there that she's working with. We may fly the drone.
Fly the drone. They love that shit, Dustin.
Yes, we'll do that. But then I had to book going out to Mastermind Summit. I had to book my plane trip up to Michigan because I'm going to go speak at the Michigan Mortgage Lenders Conference. That's going to be a good time.
All Delta? You're racking up the miles in this Q1, huh?
Yeah, trying to figure it all out. But then here's what I'm really excited about. I'm actually leaving Las Vegas on that Friday, and I'm going to head to Seattle, where my wife, my son, and I, and potentially his girlfriend, we don't know yet, we're going to go spend 2 nights at Mount Rainier, do some hiking.
Oh, I love that.
And then we're going to go into Seattle because I want to go to a Mariners game. Definitely want to go have dinner on top of the Space Needle. Like
Shout
all
out
the
Ichiro.
touristy.
You going to go to Wajimaya Market and get a gooey duck thrown at your face?
I don't even know what you're talking about, but I'm going to go to Pike Place.
Yeah,
is that also?
Wajimaya Market and say, throw a gooey duck in my face.
If that's what you tell me to do, John, I'm going to do it.
You know I'm not wrong. You're going to go down there and be like, wow, this motherfucker was not kidding. There's a gooey duck in my face. You don't know what those are?
No, I don't know what a gooey duck is.
Oh, my God. Dustin.
Is it a food? Is it edible?
I mean, you can eat it. I don't know if I suggest eating the shit, but yeah, you can eat it.
Well, then I will look for a gooey duck while I'm there. No, so I'm pretty pumped up with the travel that we have coming up, the cool shit that you and I get to be a part of. At the same time, like I think our audience needs an update on like, hey, what's going on in the markets, right? Because a lot of times their heads are down, their blinders are on, and they're grinding. And why? Because we coach them to do that. Head down, blinders on, and grind. But we make sure that on behalf of them, that we curate the news. We know what's going on so we can be their source of information. So when it's time to come up for air, which is maybe right about now, let's figure out, based on what we thought was going to happen 5 or 6 months ago, we are the first 3 months done with 2025. We are in the heart of Q2, staring down the barrel of Q3, right? That's what comes next. At least last time I counted 2, then 3, then 4. What's some of the hot topics in the news that we as mortgage and real estate professionals, we should be aware of? I think that's what we're going to jump in today. It might not be a long episode.
I hope not.
I'm not going to jinx it, but it might not be long.
God, every time you say that shit, I'll be here for like 50 minutes.
Well, hopefully not.
You say hopefully not, but every
I'm
time.
hungry, John. I want to go to lunch.
And
lunch is right after.
You remember them classes?
Episode.
You remember them classes you had in college? Had like once a week, but the class was like 2.5 hours long.
They were my favorite.
That's how I feel every time I sit in this seat.
But those are my favorite classes. I used to take one on like a Thursday night.
I hated
Here we
them
go.
shits.
Now you got me down a rabbit hole.
3 hours.
Yeah, it was never 3 hours. It was like 2 hours and 15 minutes. So my buddy Jason and I, we would go to the bait store, and we would get like 6 dozen live shrimp. We built a live well. By we, I mean he built it. Built a live well. We'd have the live well feeding off of a car battery in the back of his truck. We'd go to that Thursday night class, and then we'd get out of class around 9:15, and then we'd take a 2-hour drive to our favorite fishing hole, which was Sebastian Inlet, right on the east coast of Florida, and we'd fish all night long. That was like the good old college years.
You didn't mention class once.
I said I went to class. That was the
Yeah,
Thursday night
that was
class.
your fucking meetup spot. Like, hey, meet me at class so we can leave after. That's
Yes.
I didn't fucking go there to learn.
Hey, look, I have a degree. It's all I have to say about that.
All right. And since we have to pay these bills, here's a ad from our sponsors or some shit.
What's the number one value in business coaching in all of America? Well, simply put, it's TLOP's Originator Coaching. If you want more information about how TLOP can invest in your future success, go to our website, tloponline.com. That's TLOP online.com. Click the link for our coaching session. See all of our products that we offer. And if you have questions or you want to have a one-on-one with one of our TLOP team members, go ahead and book your free 20 minutes with us and let one of the TLOP team members help you decide which of our business coaching and sales training would work perfect for you.
And we're back.
By the way, you keep on saying it's an ad from our sponsors.
You-
It's today's show is sponsored by. Now, if people want ads, hey, FYI, where's the camera? Which one do I look into, John?
You can look into all three, Dustin.
Okay. If you are interested in becoming a true advertiser, yeah, go to our website, tloponline.com, and under media inquiries, you can inquire. We have advertising packages that we will be selling by Q3. But right now, we have show sponsorships.
Yeah, that's what I meant to say.
Okay, well, a show sponsorship is a little bit different than a actual advertising partnership.
That's a phrase an advertising major would say.
Yes. Well, it's a difference.
No,
There's a difference.
Minutia.
Okay. So anyhow, thank you to our show sponsors. No, let's just go ahead and jump in. Hey, what's going on in the world of mortgage and real estate? Well, at the top of the news right now, and this is the first I'm actually hearing it mainstream. Like it was being talked about behind the scenes.
What that is?
The Sovereign Wealth Fund.
I'm sorry I asked.
Have you heard about the Sovereign Wealth Fund? So in general, and this is not an episode about sovereign wealth funds, and I'd have to get on my buddy like Steve Curley to actually talk about sovereign wealth funds.
The dentist?
His brother. Because Steve is a chartered financial analyst, and those dudes know shit like this. But let me just tell you the layperson's understanding. A sovereign wealth fund is typically a fund that is sponsored by a government, and it's typically something that the people, the citizens, can invest in the way you would a mutual fund, right? The way you would an ETF, the way you would any other type of investment. But you typically only do it when your government has a surplus of revenue and not a deficit, right?
Sense.
Like we run at a budget deficit, not at a budget surplus. It's been 30 years since we had a surplus.
It's a way to live.
Okay. If that's the way you want to live, then so be it. So it's a little interesting that our current Treasury Secretary, he's talking about a sovereign wealth fund, which look, not this episode. I'm not the subject matter expert. I'm just going to speak in layperson's terms, the way that I understand sovereign wealth funds in general. But what's really interesting is the discussion of privatizing Fannie and Freddie, the GSEs, and putting them into the sovereign wealth fund.
What?
Which ought to be interesting if they're ever able to pull this off. I think we're way too early to do much content and much digging, but it's at least something to be aware of, that what we do know, because we knew it with the last Trump administration, and we knew it was going to be a part of this potential second administration, that the administration, wants to get Fannie and Freddie out of conservatorship, which I don't think there's many people who disagree that would be a terrible idea. Like people think, yeah, it's not a bad idea. And, but then the newest idea is A, get them out of conservatorship, and then B, privatize them, and then put them into the sovereign wealth fund.
Oh, so, yes.
Yes,
That
right?
sounds amazing, Dustin. A fund. Can you fucking say it in English? So
I
basically,
mean, look, and then I can say this at least. Like, we do have from experience, from resume, from formal education, like Besant, who is the Treasury Secretary, like the dude's super smart and experienced. So I can't imagine this is a idea born from dum-dums. I just don't know if this is an idea that is actually something that's going to be able to pull off, because here's what I can tell anyone. Here we are in April of 2025. Most of the mortgage and banking industry isn't like wildly crazy about rushing out and removing Fannie and Freddie from conservatorship, from taking them private again. Now, don't get me wrong. I own Fannie Mae stock. I've owned that shit for over a decade.
Word.
I would love for it to go private, because that's the only way that I'm ever going to see my stock be worth anything.
Pay daddy.
Yeah, pay daddy. But when you talk to the Mortgage Bankers Association, when you talk to leaders in mortgage and banking, what you'll say is like, look, if we're going to take this private, what does this mean? And most experts think that the minute Fannie and Freddie go private and they're no longer under conservatorship, we will see mortgage rates go up. From whatever current level they're at, they will go up. And there's a fear that what is it going to do to people's abilities to purchase and finance vacation properties? What's it going to do for people's abilities to purchase and finance investment properties? Now, there's always been a debate. Should that be the role of Fannie and Freddie? Helping John Coleman and Dustin Owen acquire Airbnbs or helping us buy investment properties. Like, maybe that's not the government's role, but it's just something that we're watching. And we'll continue to watch. We don't foresee 2025 as being the year that Fannie and Freddie are successfully taken out of conservatorship. But what is worth watching with Fannie and Freddie is Bill Pulte was approved to take over the helm, and Bill has come in. Bill's the head of the FHFA now, and he was appointed by the new administration, and he was voted in by Congress. And Bill's making some crazy changes now. And I'm not here to debate whether those changes are good or bad. I'm just saying, hey, look, he's making some changes. He's firing some people. He's cutting a bunch of staff, and he is appointing new board members that may or may not have experience in this space. It's just something as an industry we're watching, because in general, uncertainty is rarely good for business when the business that you're in has to do with the economy and the business that you're in has to do with like personal finance. Now, again, this may be one of those one step backs for two step forwards. And anybody who's been advocating for real change understands that this may be what is required, and only time will tell, like 9 months, 18 months down the road. But until then, you're going to have a lot of people in the space that are walking on eggshells, that are tiptoeing around being like, hey, what's going on with the GSEs, the government sponsored entities? That's Fannie and Freddie. Are they ever going to be released from conservatorship? And then are we really going to put them into this sovereign wealth fund? And then what is a sovereign wealth fund? And is our country ready for it? And is this what's good for the greater taxpayer? So all things worth watching that I don't think we were having these conversations in December of 2024. We sure as hell weren't openly talking about sovereign wealth fund. We sure as hell weren't, Bill Pulte hadn't been put in charge, and he hadn't come in and he hadn't fired and cut staff, etc. And all this is now happening. So we are in a wait and see moment. And there are many in the industry that are on pins and needles because of fear. Could be, is this really good currently for housing? What if interest rates do go up? What if they make it harder to obtain affordable financing for second homes and investment properties? Or you even have this one. What if they cut so many staff that it's just services in general are taking 2 to 3 times as long? Like if I'm a mortgage lender and they're taking 3 times as long to purchase my loans, that impacts my business model. That is more money I have to pay in warehouse line interest until I get that loan sold. And why could it take Fannie or Freddie more time? Because they have less people. right? Like, I'm not saying there weren't inefficiencies. I'm not saying that they couldn't have been bloated, or I'm not saying that their technology isn't archaic and it could be updated. All I'm saying is that this change is one in which there's uncertainty and people are kind of mildly freaked out about it. Maybe some are mildly optimistic, but everybody's holding their breath and nobody is excited in a positive manner where they're openly and overt with their excitement. Wow. You're so zoned out right now.
God.
So zoned out. All right. You want to slide into the CFPB before we get into interest rates?
Yeah, I
and
thought
home
we got rid of
appreciation?
that. I thought we got rid of the CFPB. Next question.
Because those are the last two. The last two things we have to update people on is CFPB, interest rate forecast, and home appreciation forecast. And I have a really cool stat regarding home builders that I think is a little bit of an aha moment, but it's also a, well, no duh moment.
Right.
Okay?
Builders are building is an increase of 2%.
What?
Increase of building homes has skyrocketed 2% month over month. So now we're going to see an increase of available homes on the market, Dustin.
Do you know that for a fact? Did you read that in Housing Wire?
You think I read Housing Wire shit? I love you, Housing Wire. Send me a hoodie. You still owe me that one. I still don't have it. Shout out to my boys Redder who did though.
Yes, shout out to Redder.
No, but I'm just pulling out of my ass just like everybody else on TV. Was I wrong or right?
I mean, I don't know. I'm not going to fact check you because I ain't got time for that.
So
So
go ahead,
you
Dustin.
sounded pretty good.
I mean, if you put conviction in your statement, you can make almost anyone believe anything, Dustin.
All right. So I'm not going to discuss that because I did not do my research, and I would hope people don't fact check me.
Don't fact check us at all.
But no, so the CFPB, what's new with the CFPB? Not a whole lot right now. I mean, look, there's lawsuits that are going on where the federal government came in and they terminated a bunch of contract workers. Contract workers are suing, and it looks like the judge is going to rule in the favor of the contract workers, which means the CFPB is going to have more people showing up to work instead of less people showing up for work.
So let me get this straight. The whole news line was we need to dismantle the CFPB, but when the dust settles, there's going to be even more employees in the building.
No, there'll still be less, but they'll be not as less as they originally anticipated.
Well, when you say dismantle, I thought it was completely going away. Like you dismantled my car. I can't open a door and drive away in it, Dustin.
So everything's being debated right now, right? So it's like just because you can doesn't mean you should, and just because you will doesn't mean it's legal.
Jesus.
Okay? So you have that going on. I think that's what makes our government awesome. It's the checks and balances aspect. So you have, 50% of the people believe in one thing, 50% of the people believe in the other. And honestly, my take, 30% people believe in one thing, 30% believe in everything, and 40% of people don't give two shits.
Correct.
Right? There's like, leave me alone and let me do my thing and don't screw it up. Mm-hmm. Is really what transpires. But they want us to believe that 50 think one way and 50 feel the other. No. 40%, which is more than 30 on either side, all believe in the same thing, which is we don't care and leave us alone. So yes, the CFPB is a situation that we're still monitoring because I do not believe it's going to be totally dismantled, but it could have its fangs removed, or it could be reworked and it could be reworked better. We still don't know. But right now, what I do know is that we do have a CFPB director. Don't know if he or she's doing anything, but we know that one's been appointed. We do know that they came in and they terminated a bunch of people. And some of those people went to the courts and said, this is bullshit. And the court said, yes, we think this is bullshit, that this proper channels or protocol wasn't followed. That said, will they actually go back to doing their investigations? Will they actually go back and start initiating audits and penalizing people who are not playing by the rules?
Probably not.
Probably not. Yeah, that's my take too. Probably not. But as we've talked about before on this show, this is not a get out of jail free card for any lender or any consumer lending company, because the states have power. And states can still audit, and states can still levy fines or create lawsuits if they feel like businesses are doing business in an unethical manner that harms the consumer. Right? So it's not a get out of jail free card. The call to action for all of us in the mortgage industry is still be good people. Still play by the rules. You know what the rules are. Still play by them. Plus, you never know this. What happens if there's a brand new administration in 3 years? And that new administration comes in and they reverse course on everything that went down the last 3 years.
That's usually how it happens, Dustin.
Okay, well, then all of a sudden, if you were not playing by the rules in 2025 or 2026 because you thought you had a get out of jail free card, the new administration comes in 2028.
Cook the books before then, you'd be all right.
And then all of a sudden, it's not about cooking the books. You can't do that, John. That's how you go to jail. That's how you go to prison, Bernie Madoff.
Oh, you operate in the gray, and until someone else next to you gets caught, that's when you straighten up. That's the American way.
Arthur Anderson. I mean, do I need to keep on?
Wow, it sounds like you studied it.
Had to. And that's how you get that CMB, baby.
Really? You had to get to study that shit for your CMB?
Yes.
You should wear that pin more often, Dustin. It costs a lot of time and a lot of money.
Yeah, it's all right. All right, so then let's get off the CFPB. Let's talk about interest rate forecasts.
All right, probably going to stay the same. Might go up a little bit, might go down. Can we please stop talking about interest rates? If you need the house, buy the damn house. If you're ready to buy the house, buy the house. If you can't afford the house because you're too poor, keep renting. How many times do I got to say it?
Ladies and gentlemen, John Coleman.
Jesus Christ. If like 10% interest, buy the damn house. I'm tired of people bitching about 0.25% interest rate, par pricing, all this bullshit.
Well, we are still under the belief that it's going to take a 5 handle to unlock this inventory to get sellers to move. And it was looking positive, but we still think we have some headwinds. I mean, we really need the labor market to be less robust. Yeah. And we think the labor market's cracking. We think the labor market is not as strong. I just read a report by our guy, Elliot Eisenberg, right? Elliot Eisenberg, Econ 60, he's worth following. And the sentiment amongst CEOs is the worst it's been since like when COVID started, like spring of 2020. Wow. It's pretty rough. And there's another like forward looking survey, and that survey was one in which they're talking about sentiment again, like overall business sentiment hasn't been this low since like 2009. Let's go. Yep. So all in all, that's terrible. Except for if you're a homeowner looking to refinance your mortgage. Hell yeah. That's terrible except for if you're a mortgage lender looking for rates in the 5s. That's terrible except for if you're a home buyer who's just been waiting for homes to become more affordable. Home appreciation's definitely slowing. Really? Yeah. Uh-oh. Yeah, definitely slowing. Like definitely slowing. Like we're looking at now a national average home appreciation in 2025 of being 1% to 2%, where it was hitting like 5% and 6% the previous years. And historically, it's always been somewhere around 3% to 4% historically. And there's going to be certain pockets. Like there's some markets in Louisiana, some markets in Texas right now. The D word, depreciation? Where, 3-5% depreciation. Look, that only impacts somebody that's like trying to flip a house. Most of us need a home to live in for the next 5, 7, or 10 years. So if I bought my house for $390 and it went down to $350, but eventually I sell it for $600, do I really care? No. And that's kind of like me looking at my 401k statement. I'm 46 years old. Do I care if my 401k statement went down by 10%? No, I don't. Why? Because I can't touch that money for a minimum of 9.5 years. Shit. Right? So it's like, I don't care about that. Most people, if their home dips a little bit, no big deal, right? Like you can't time the market. You time, as you just said, when are you ready? And if you're ready, and this is something you're going to own for 5, 7, or 10 years, then you jump in, you become a homeowner. But there are definitely pockets in the U.S. where home values may slip a little bit. There's a couple markets in Florida we're watching. There's like 4 or 5 markets in Louisiana we're watching. There's a couple markets in Texas that we're watching. But there's also certain markets where we're anticipating 4, 5, 6% appreciation, which is why you get a national average of 1.2. So that is what we're still looking at, 1.2% average appreciation. Interest rates into the low 6s. I don't know if we're going to be able to see the 5s. That's the big unknown. The big unknown is just how rough could the U.S. economy become, right? Do we get to a point to where we are in a recession and the labor market is feeling the impact? At that point, we could see some rate relief. You also have a president who's going to do his best to bully the Federal Reserve to change their stance on fiscal policies. And that could benefit the American consumer if he gets his way. Now, normally the Federal Reserve is supposed to be an independent of, so you can't politicize it. So we'll see how strong Jerome Powell and his crew actually are at staying their course, whatever their course may be. And you also have this whole like tariff concern is still out there. And every day the tariff's like, oh, we're going to apply a tariff. No, head fake, we're not. Oh, this country's going to have a retaliatory tariff. Oh, that's going to cause inflation in the U.S. And we know that inflation is not good in general for any interest rates or mortgage rates. But then again, because we're doing an update, we just saw that the that the Treasury has announced they were doing what was called quantitative tightening. So that meant they were allowing certain treasuries, certain bonds that they had purchased to, when they fell off their book, because usually they prepaid or they matured, they weren't rebuying, right? So it was just a way of basically like trying to, like let's say you got rid of 2 shirts but didn't go buy 2 shirts to replace it because you looked in your closet, I got way too many clothes, right? So you were doing what they call quantitative tightening. Quantitative easing is the exact opposite. You look in your closet, say, I don't have enough shirts, I need to go out and buy 10 shirts. Quantitative easing is when the Treasury or the federal government starts purchasing a bunch of bonds, a bunch of treasuries, a bunch of mortgage-backed securities. Well, at least it was announced most recently that they were going to start repurchasing the same dollar amount that fell off. So whether it fell off due to prepayment or fell off due to maturity, that's not a bad thing for the interest rate market. Now, they haven't announced that they're going to do it for MBS, for mortgage-backed securities. They did announce that they're going to do it for treasuries, but typically those two tend to run in tandem. So that's going to be something that we're going to watch. But right now, there isn't anything in the cards that make originators like me do a backflip that we're going to see 5.75 as the average interest rate. Mm-hmm. But we also are not concerned about rates jumping back into the 7s, right? So there's a quick interest rate forecast. And finally, this is just a cool little tidbit I learned by reading a earnings report. Okay. So it was reported by Lennar, America's #1 home builder, that in Q1 of 2025, so the quarter that just ended, they actually had 12% of their quarterly earnings going towards incentives to induce buyers to buy. That's a lot of damn money, John. That's basically home builders saying, if we did not put all of these incentives in place, subsidizing super low interest rates, paying all closing costs, doing crazy upgrades at no additional cost, paying real estate agents fat commissions to bring home buyers their way, had they not been willing to do that, they would not have sold as many homes as they did. So this is a softening of the market. This is not good for home builders in general. And in their earnings report, Lennar did mention that the spring home buying season has not started off as robust for them as they anticipated. So this is something that we're going to want to monitor. We're going to want to watch, because ultimately the way of new construction could be the way of the entire market. But I think once interest rates do get down into the 5s, whenever that case may be, then home builders like Lennar will not have to have upwards of 12% of their revenue going towards incentivizing home buyers, because right now they're doing it primarily to make homeownership more affordable, because interest rates at the time may have been 7% and they were trying to lure buyers in with a 4.99% interest rate, which in order to do so, they had to cut into their gross profits in order to pay the lender who was facilitating what we would call in the industry a builder forward commitment. So that was just something interesting to watch, is what's going on in new construction. Are builders making money? Are builders starting new projects? And if so, at what price point and what market? All in all, though, I'll say this: I'm pretty optimistic. Oh,
that for just optimistic?
I'm gonna trust the process.
Bro,
I'm asking my branch managers and my loan officers to trust the process.
Interest rates will dip down below 5%. You know when? When you go into your favorite local grocery store and you see AI robots walking around everywhere, because that means nobody will have a job. That will hurt the job market, and that will mean interest rates will go down. You're welcome.
All right, John. Well, I appreciate that. Do you have a time frame you want to put that on?
I think we're going to start seeing like robots in the American economy, like, because it's already overseas, they're everywhere. I think we'll see them appear probably by the end of this year, so like end of 2025. By middle of 2026, you're going to be like used to seeing robots like pumping gas and being everywhere.
Interesting. Well, John,
let's
timestamp that.
You know I'm not wrong.
Let's timestamp that, and I can't wait to circle back and see how John Stradamus comes through with his predictions.
Let's go, but yeah.
Let's go. But hey, this was just a lighthearted, hey, let's get caught up on what's going on in the markets. Y'all, you've just tuned in to Loan Officer Podcast. We appreciate you taking the time to hang out with us. Do us a favor. If you like this type of content, if you think we're doing a good job, please share us, not once, not twice, but 3 different times with colleagues and other professionals that do what we do for a living. Make sure you're subscribed on YouTube. Make sure you have signed up to my newsletter that I write every single week. You sign up for it by visiting our website, which is tloponline.com. And over on Instagram, follow us. We are at the Loan Officer Podcast. And on LinkedIn, I'm first name Dustin, last name Owen. If there's ever anything I can do for you, I promise you, test me. Send me a message on LinkedIn, and I promise to be uber responsible, and I will do my best to get you pointed in the right direction. He's John Coleman. I'm Dustin Owen. That's all the time we have for you today, but we do look forward to catching you on the next episode.